Is the era of big cap tech over? Hi, everyone. Welcome to the Real Vision Daily Briefing. Joining me today is Eric Jackson, president and founder of EMJ Capital. Hi, Eric. Welcome to Real Vision.
Hey, Maggie. Thanks for
So this
having
is
me.
your first time on the Daily Briefing, if I'm not mistaken. So why don't you give us, before we jump in, why don't you give us a little overview of EMJ? So what's your area of focus?
So it's tech focused. It's a long short fund, but I tend to focus on multi-year compounders. So I'm trying to find companies that over a 3-year basis can 2 or 3x, if not more. And so the portfolio tends to be more concentrated. Tends to have less turnover. A lot of since I'm expecting to hold these companies for longer periods of time. So it tends to skew, therefore, kind of more small to medium cap rather than big cap tech. Not that I don't like, Apple probably is my favorite big cap tech name. I think it's a great run company and it's had a great year, all things considered. But it's obviously very difficult when you're one of these big cap tech stocks to double or triple from, its already existing multi-trillion-dollar market cap company. So I'm trying to look for the next ones coming up generation.
We all are. So this is going to be a good conversation, especially now. So by the way, if you have a question for Eric as we're having a chat and going along, you know what to do. Put it in the comment section on the website, the chat box on YouTube, or you can tweet us at Real Vision. So Eric, we're in this interesting period. It was another tough day for U.S. stocks. We're just closing the U.S. session and NASDAQ getting hit the hardest, but there were losses across the board. NASDAQ down 2%, Dow down 1%. S&P off 1.5%, Russell down too, 1.5%. And it seems like we talked about this yesterday. It seems like everyone's getting kind of more bearish again. We had energy, technology, and communication services leading the way lower today. What's your outlook? Where do you feel like we are with U.S. equities?
Yeah, I think just in the last few days, I think financials people have been particularly bearish about, and so I think that's sort of hung over the market the last couple of days, especially. So I would, and if you look at the twos, tens, inversion today, I think it's set a new all-time low for this current cycle, and it's also the lowest that it's been since, I believe, October of 1981. So we're going kind of way back to pre-financial crisis, to kind of the last time there was this huge inflation scare. And so I tend to be a little bit more optimistic, though, given how far inverted the yield curve is and how much damage has been done in 2022, especially in the world of tech, especially in the world of kind of smaller cap or growthier tech names. Some of these names are down 70, 80, 90%. So my view is that a lot of damage has been done this year. So looking forward into 2023, we see just the beginnings now of inflation starting to roll over. And even though there are concerns that 2023 could be a deeper recession than expected, I think that from a stock ownership perspective, I really think that if we continue to see inflation kind of fall off a cliff, that will be bullish for stocks in general. And I think tech stocks and growthy tech stocks in particular. I think the growth tech stocks were the first ones to really show major weakness a year ago, that kind of signaled that we were going into this corrective phase. And I think those same types of names are going to be the first ones to kind of herald a turnaround in stocks, which will come before the general economic recession starts to turn.
That's interesting. So I want to drill down on that a little bit more. So do you think that the market is too pessimistic about the recession that's coming, or is it more just a case that so much of that bad news is already priced in? Not that we're not going to see a sharp recession, the yield curve's wrong, but it's just that these tech stocks, especially the growth ones, are just so beaten down that it's already in the price. Or both.
Yeah.
I guess it could be a combination.
Yeah, I mean, there are a lot of bad things out there, and you tend to hear a lot of people, especially macro strategists, talking about 2023 about how corporate profits kind of need to go down and they haven't been reflected yet, and so forth. Um, but yes, there has been so much damage done. The yield curve already is signaling us that there is going to be this sort of deep recession coming up. That and when you and so I referenced this kind of 1980, 81, 82 time period. Like that was the last time we saw an inversion this deep. If you look back at that period as sort of a guidepost to what might happen today for us, what's interesting about that period is that was obviously the last time that there was elevated inflation like there has been over this past year. In the early 80s, it was even steeper. It sort of peaked out in 1980 at around 15% CPI inflation, and so at that period, the deepest part of the yield inversion happened in kind of the spring of 1980 when CPI was at 15, and it started to come down, but it came down from 15% to about 10, 11% by the end of 1980, and then it hung around for 1981. Inflation really didn't budge from that kind of 10% level. So you ended up having a rally when people thought inflation was starting to come down, but then the rally stalled, and we kind of had this double dip back then when there was this persistent inflation. Inflation finally rolled over in 1982, in sort of like the summer of 1982, and so it started to drop quickly. And by August of 1982, it was passing like 6-7% on its way to ending 1982, going out of that year around 3%. So so the big rally that followed in equities started in August of 1982, when market participants really felt like the Fed had finally licked inflation, and this thing wasn't just going to stall out again, but it was sort of like well on its way to kind of back to 2-3% normalcy. And so I think that we're not starting as high. Obviously, we never got up to 15%, thank goodness. And even though some people will say, this thing is going to be persistent, inflation is going to hang around, and so forth, I think we're seeing a lot of the forward indicators show that things are really slowing quickly because of fears of a recession. And so I think it's more likely that we're kind of, as we move through 2023, we're going to see evidence, month by month, that CPI is continuing to march down. Maybe we'll end 2023, back at that 3% level. But I think once people start to get a sense that this thing inflation is decidedly moving lower, I think that will be the signal that stocks can rally. And then going back to 1982, when there was this kind of market bottom that occurred in August 82, and people felt like, okay, CPI is finally going down for the count here. The NASDAQ rallied over 100% over the next 10 months. And I think, given the kind of contraction that we've had in, late 21 and through 22, we could see something, similar to that. S&P rallied, not as much as the NASDAQ in that period of time, but, it had a strong rally as well. So I think we could be setting up for that kind of scenario in 2023. Is it going to, I don't think it's necessarily going to happen with the December CPI report, or maybe not even the January one, but I think we're on the road to kind of seeing kind of a steady move down in these numbers. And I think that's going to be the unlock for stocks to rally and for people to get more constructive, even if, unemployment is rising, there's concern about how deep, the recession is and so forth. I think people will say, hey, stocks got, we're beaten down for so long. Now inflation is licked. It's time to dip the toes back in the water of owning some of these equities.
Yeah, that timing issue is always so tricky, isn't it? I want to ask a question. Fred on YouTube is asking something that's related to the question we posed at the top of the show. He says, with the lack of innovation, I think that might be a debatable point, but with the lack of innovation and regulatory problems we're seeing with big tech, Should the big guys get lower PE ratios?
I don't know if the correction that big cap tech has experienced in 2022 has been, I wouldn't say it's been because of a lack of innovation or regulatory overhang. I think it was just sort of their time, their time to go into the box, to be penalized. I think there was sort of like some of the late cycle action that happened in 2021 is that big cap tech had a great 2021. And so, but under the surface, a lot of growth names, including like Cathie Wood's ARC, sort of peaked out in February of 2021. So there are a lot of smaller tech names that really have been in a bear market now for almost coming up on 2 years, in a couple of months. And so people rotated out of those growthy ARC names in 2021 and piled into big cap tech. And that lasted a while until it didn't. And I think, who knows what the catalyst was moving into 2022, but, obviously like many of those names, maybe save Apple, have been having a lousy year this year, just because they've, had troubles keeping up with, keeping up to the levels that they had been used to, their growth levels. And then people just saying, okay, maybe this isn't the safe haven that I thought it was. So going forward then into 2023, my views on big cap tech are that I like Apple the most. I still think it's kind of well positioned to kind of bounce back, even with these kind of fears about are they going to be able to make enough phones in China. And, we've already seen Chinese tech stocks have a huge rally just in the last 30 days or so.
Yeah.
And so, if that continues, eventually, Apple, will benefit from that as well. So I like them the most. The other names, I think, in general, they look interesting after the pullback in 2022. I probably like, Microsoft and Amazon more than I would, like Facebook or Meta. I think that even though Meta's gotten really cheap just in the last, couple of months because of their last earnings report, I think you're still going to have questions around how much are they going to continue to spend on the metaverse and all this kind of stuff hanging over the stock. So and Google, it's interesting. I noticed today, they're down a little bit, maybe 2% from their recent highs, but given how much attention has gone to this, AI chat engine just in the last few days, you would think like they would be affected more because it's kind of a direct competitive threat to their business if this thing really does take off. But so far it hasn't affected them. But
yeah. It is interesting. I guess it speaks to their just incredible dominance. You have some. So clearly, you're looking at the sort of smaller to medium for the companies that you see the greatest potential to really move. Before we get to that, though, because you mentioned Apple, I just want to ask you about this because we did have headlines, just reports out in the last hour or so, say that Tim Cook says Apple will use chips built in the U.S. at an Arizona factory. This issue of supply chain concerns looks like it's going to remain, no matter what happens in terms of China, just everyone kind of rethinking the resiliency of their supply chain. My colleague Andrea spoke with Whitney Baker, the founder of Totem Macro, who said that she thinks this issue is not only going to stick around, but going to create sort of longer term shifts in spending. Let's have a listen to a clip from that.
But the thing about tech is, I think the bigger point is not so much that like globalization and thinking about supply chains and security of supply, it's going to affect all sorts of industries, not just tech in particular, because we've come out of 15 years of no investment across pretty much any industry, right? And even like looking at semis, it was the same. It was like, okay, from 2015 onwards, revenue surged for advanced semis. The whole total annual size of that industry continued to go higher. And yet there was no incremental change in Capex from 2015 through to 2022. And so then you I should say 2021, because then there was a big Capex response. But you're growing into what was like a very limited availability of supply. And that same thing is true with respect to tech as it is with respect to energy and basic materials and, industrial or manufacturing capacity, housing. There was literally no investment in anything physical for most of the last cycle. And so you're just hitting these supply issues at the exact point in time when people need to figure out, okay, well, we need to actually expand capacity. Where is the right place to do that? So these two things are intersecting at the same time, which means that the potential for that shift of Capex to new sort of destinations and recipients is probably bigger than at a point when, let's say, everything was already oversupplied. If everything was already oversupplied, you're sort of going to like get the longest useful life out of those things as you can, and maybe walk a little bit of a balance between using that stuff, using the capacity you've already spent money on, but also trying to have some sort of tail risk or hedge capacity somewhere else. And now it just seems like, look, everybody hasn't invested for a long time. They got to do it anyway. They're going to try to do it somewhere friendly or somewhere where you at least are taking into account as a factor how secure that place is.
And that full interview is available on our website. Eric, is this an issue you worry about? Are we looking at increased Capex costs across the tech sector being an issue for profitability?
I mean, it's a general secular trend that people, not just in tech, but I think across industries are going to be diversifying their supply chains away from China to multiple locations so they don't kind of get caught holding the bag, with some geopolitical event. So as a result, it's hard for me as an individual stock picker to kind of see, should I pick this company stock because they have less exposure to China than others. I mean, I think oftentimes it comes down to like a relative comparison. Like if you have a bullish view on a semiconductor stock, you want to look at that stock in relation to the other semis, in that sector, or SaaS stock, or what have you. So I just think it's a general trend. It's going to continue, but I don't think it's really going to be the basis of, for me anyway, making stock decisions. And the same thing with kind of the U.S. Whenever I hear an announcement about we're going to invest, even if it's Apple is going to invest in Arizona, wherever they're going to build the chips. I mean, that's just a multi-year process that's going to have to play out. And so not something to kind of base a decision about owning a stock for the next quarter or two.
Yeah, that's fair enough. So Ralph is saying, forget big tech. What's the next tech? What are some of the companies that you're both bullish and bearish on? So let's go through a few of them, because you did send a list. And just for disclosure, I'm assuming that you currently hold positions in all of them. Is that correct?
Yeah, the ones I sent you, yes.
Great. So first one is FREY. So talk to me about that, a battery maker. So this is an EV play?
Yeah, it's actually a SPAC that's up on the year, and it's had a good.
There's a SPAC that's up on the year. That itself is news.
Even trading above $10, if you can believe that. So, and it's a pre-revenue EV battery, and it's a battery company. It's going to play in the EV space, so it's going to supply their batteries to autos, but also probably more importantly to energy storage solutions, which is kind of an interesting little niche market for batteries. But I think the big story here with them is that they actually, especially for a SPAC, have a solid management team. They hail from Norway. They are building 2 gigafactories right now for their batteries. One will be in Norway, and one will be here in the U.S. in Georgia. Actually, they just announced a few weeks ago. They have a JV over here with Koch Industries to build that. And so what's interesting is that everybody agrees, EVs are the future. We need batteries, and yet most of the biggest battery suppliers are in China. There are a few in Japan, but just speaking to the conversation we were just having about onshoring, if you can buy from an American friendly supplier or a European one over a Chinese supplier, assuming quality is sufficient and all that kind of stuff, you would probably choose to do that. And yet there just aren't that many around, even though this is a big growth area. And so this Fryer is set up to kind of to be that supplier. They have the right, the right geographic location. They have the right partnerships in terms of supplying the materials that they need. They have the right template, which they've licensed from a company called 24M Technologies out of MIT. But the big thing that they need is capital. And so there's a certain amount of risk attached to them. That are they going to be able to raise the capital that they need? They just did a stock offering just within the last week. I think they raised something like $265 million from shareholders. So the stock has taken a bit of a dip in the last week or so. And there's rumors that they are going to do a deal to raise some further money from one of the big private equity shops, something to the order of like 500 million. And so they're well on their way to kind of raising capital. By Q1 of next year, they should have the first, what they call the customer qualification plant, where they kind of prove that they can make these batteries. And so by kind of the end of the first half of next year, they should have, a bunch of customer announcements already out. They've had some already. They should have a lot of capital raised, at least to kind of fund their kind of first phase of build out of the Norwegian Gigafactory. And the reason why it's an attractive stock is just that it's going after this massive opportunity. The enterprise value is still less than $2 billion. And so it can massively compound if they are successful. If they are able to show that they can build.
The EV space is so hot, and batteries are the big problem to solve. So
yeah. So if you are comfortable taking the risk that they're going to be able to execute, build these things, and that they're going to raise sufficient capital, it's a potential kind of not just a 2 or 3x compounder, but a potential 10x over the next 5 years. So that's why I like it.
Yeah, this is an interesting one. Bombardier, the aerospace. How is that on your list?
Yeah, it's probably the one that's
going up against, by the way, the two big ones, right? There's always the battle between Airbus and Boeing.
They are they used to be this like massive conglomerate out of Quebec in Canada that did big jets, medium-sized jets, private jets. They built the subways that people go on when they're in Manhattan. So they were in rail. They did the skidoos and the sea-doos that people see sometimes. All these recreational products. And so in 2018, 19, and up to the pandemic, they decided we're going to get out of all those businesses. So they don't go up against Boeing anymore. They don't go up against Embraer in terms of supplying the bigger jets. And they got out of the rail business. They got out of the recreational, sports business. So they are a pure play private jet company. So they have some competitors, but the competitors that they have are like Gulfstream, Textron, the French Dassault jet makers. So they are now supplying kind of these private jets to the elites of the world who fly around, and are flying around actually more today than they were pre-pandemic. For a while there, it was the only way to get around, and a lot more people who got used to flying business class on commercial jets just tried private and found out that they liked it and are doing it more. And so the thing that's special about Bombardier is that they tend to focus on the larger of the private jets, kind of the ones that can fly further. So they got sort of out of the really small private jets and focus on a bigger jet that could fly nonstop from Phoenix to Singapore type of thing. And those cost more. And so when you put in the effort to actually build these things, and you build hundreds of them, you get certain operational efficiencies and a bigger price tag attached to them. And so they have been getting better and better, and we're able to kind of get through the pandemic just fine. And in fact, have gotten a little boost with extra orders. I think what was hanging over the stock in 2020 was once they got out of all these diversified businesses, they still had a ton of debt that they were carrying. And so there was concern that, are they going to be able to keep up with the payments and so forth? But their cash flow has been steadily increasing over the last couple of years. They've been able to pay down a bunch of debt already, and push out, some of the nearer term debt a few years away. So if I think of a comparison, it's kind of like the casinos coming out of the 2008 financial crisis, when people kind of left the equity for dead. They saw all this debt. They saw kind of very little kind of equity value left in those casinos, and the concerns that they were going to default on the debt. And then gradually over a multi-month period after that, when things settled down, they realized, hey, these folks are paying down their debt. They're pushing it off. They're repricing their debt that they have that was higher interest rate. So Bombardier is doing all of those things, and as a result, the stock has, I think it's almost tripled since June of this year. Wow. So, and it's still, it's still, again, relatively, it's a stock that the enterprise value is something like, a couple billion. So it's the market cap at least. And so as they continue to pay down debt in the next year or two, the value associated in the enterprise value is going to shift from the debt to the equity, and so that's the opportunity still with a name like that. So it's a very idiosyncratic story. They make good jets. They have a bit of a lead on their competitors in terms of they're able to beat their chest and say, we've got the biggest and the one that goes the furthest and all this, the ones that whatever the celebrities of the world want to sign up for and pay $75 million for.
Well, that's an advantage when people are not buying these things every day. So if you're a little ahead of the competition, I want to ask you about another one, which really jumped out at me, and that's Shopify. I mean, this is interesting because year to date, it's down some 70 something percent. And, a lot of people really saw this as a pandemic play and one of these, I think it got grouped in there. Why do you like it?
I like it because it's still, it's sort of like the anti-Amazon in that they're the arms dealer to all the, not just mom and pop shops, but anybody who wants to have an e-commerce presence and sell online. They have to kind of align themselves with Shopify to do that. And so that's a segment of the market which is only going to increase. And their stock has been beaten down a lot. And yet, I think they're either at the 200-day moving average or just slightly above it. So all the names that I like are above their 200-day moving average. And so, and the reason why is like they've been punished so much this year that they've, the 200-day now has sort of caught up to where they are. So I think enough pain has been inflicted from a valuation perspective. I forget where a lot of these tech names are, I think Shopify is back to like a 2018 level in terms of price, and yet it's a much bigger company today. They've recently done some job cuts to kind of rationalize that and be a little bit more focused and profitable moving forward. So I think they've got through the pain of this year. I like them into next year, and I see them continuing to surprise to the upside with strong revenue growth and show that they have a lid on costs.
Farfetch is another one on your list. FTCH, kind of in the retail space, a different story, but that stock is a pretty cheap stock. I think around $5, right? And it looked like it was down 7% on the day, so it looks like a little bit of an uphill climb. What do you like here?
They had a capital markets day at the beginning of this month, so not that a week ago, basically, and I think they were down something like 38% on the day of that capital markets day, and they just did a horrible job, I think, of communicating their longer term story. They gave kind of this very kind of cautious 2025 guidance in terms of their EBITDA and their GMV, and it left people feeling cold about it. They've always struggled to make money, and obviously this year, being negative, burning cash hasn't been good. Whether you're a SaaS company or this high-end, luxury marketplace company. So stock's now beaten down. It's at an all-time low, way below where it was in the March 2020 lows, and so it's just I just think it's overdone. At the end of the day, they're sort of the place to go if you want to buy luxury handbags online, or whatever, bracelets, and they're getting into like makeup and other stuff. But it's predominantly clothing. All the big brands are there. They have partnerships like with virtually everyone around the world, and they kind of get treated like a Chinese stock, in that when the Chinese internet names are down, they tend to be down because they do so much business over there, and yet they've got none of the bounce back this past month the way that the Chinese internet names have. So I just think fundamentally they were overly conservative in their kind of long-term guidance. Stock's been beaten down now, but I think it's so cheap that it's one where you just hold your nose and buy it.
Yeah. We're out of time. Excuse me. Uber and Enphase, ENPH, are also on your list. But we're going to have to talk about those next time. But it's great to sort of get some thoughts on individual stocks, because I think people are kind of looking in this environment where we're hearing from everyone that, passive is going to be a lot more challenging, and you need to be a lot more active in how you're thinking about your portfolio and where you're looking for opportunities. So we appreciate that kind of micro look at some of those names, Eric.
Okay. Well, thanks for having me, Meg.
Yeah, thanks. We'll catch up with you again in a little bit and see how some of these names are performing and get your thoughts on where we are with tech once we get into 2023. And thanks to all of you for watching and the questions. Hope you gave you some food for thought. Andreas is going to be back tomorrow with Jason DeSena, so be sure to check that out. Until then, take care and good luck out there.